The first company that we'll discuss today is Bondada Engineering. It is a standout small cap story in the Indian infrastructure and energy space. Since its IPO, it has transformed from a microcap player into a significant EPC force. Bondada operates in two high growth infrastructure super cycles: telecom infrastructure, where they provide passive infrastructure services, including cell site construction and fiber optic cabling. With the ongoing 5G expansion and the early trials for 6G in 2026, this segment remains a steady cash flow generator. It is also in solar EPC, which is currently their primary growth engine. They specialize in large-scale solar project execution. In late 2025 and early 2026, they secured massive orders, for example, a 945 crore solar project that reinforces their dominance in the green energy shift. Bundada is also aggressively pivoting into the BESS segment, which is crucial for balancing India's renewable energy grid. Bundada's financials reflect its rapid scaling. As of Q3 financial year 2026, the company has an exceptionally strong order book with visibility of revenue for at least the next 24 to 30 months. They maintain industry-leading return ratios with ROE and ROE consistently above 25%, showcasing high capital efficiency. Their EBITDA margins have been improving as they take on larger, more integrated projects and optimize the supply chain. The biggest evaluation factor is Bundada's transition. The stock has been a massive winner for early investors. Even in early 2026, it is seen as a quality small cap rather than a speculative penny stock. The management has been vocal about maintaining zero debt levels or very low leverage, choosing to fund growth through internal accruals and equity, which also reduces any financial risk. The second stock is Tejas Networks, which is a Tata Group subsidiary. It is currently in a high growth execution phase. The company is transitioning from a boutique hardware player to a global telecom powerhouse, driven by domestic self-reliance and the Bharat 6G mission. The latest quarterly results show a company beginning to scale its high volume orders, though it remains in a heavy investment cycle. Revenue for Q3 FY26 grew by 17% quarter on quarter, reflecting accelerated execution of the BSNL 4G or 5G rollout. While still reporting a narrow loss, the losses are narrowing significantly as the company moves towards operational break-even. Analysts expect it to turn net profitable in the coming financial year. Being a part of the Tata ecosystem has provided the capital necessary to handle a massive 8,000 plus crore order book without straining the balance sheet. Tejas is a frontrunner for a multi-billion-dollar share of the BharatNet Phase 3 project, which aims to bring high-speed fiber to every village in India. The company is also at the heart of the Bharat 6G mission. They are developing indigenous software-defined radios and satellite backhaul hardware that will be essential for the integrated space terrestrial networks. With the successful large-scale deployment of its hardware in India, Tejas is now bidding for major contracts in Southeast Asia and Africa as a trusted alternative to Chinese telecom gear. The BSNL rollout is a massive project though. Any delays in site readiness or software integration can push back revenue recognition. Currently, the stock trades at a high price to sales ratio, so investors are paying for future profits rather than current earnings. I would invest in tranches with a significantly long-term horizon. Kaynes Tech is next, and it is widely regarded as a top-tier play in India's electronic system design and manufacturing sector. Think of Kaynes as a high-end tailor. In the past, they just sewed the clothes. Now, they're starting to weave their own high-tech fabric as well. Because they now control the fabric, they can charge much more for the final suit, and their customers, which is the defense, auto and space industry, can't easily go anywhere else for that level of quality. This is to say that the company has successfully evolved from a contract manufacturer into a sophisticated technology partner for high reliability sectors. The biggest catalyst for Kaynes in 2026 is its pivot into semiconductor OSAT. By operationalizing its semiconductor facility in Telangana, Kaynes has moved up the value chain. Instead of just assembling printed circuit boards, they are now involved in the high margin business of chip packaging and testing. Kaynes is a major beneficiary of the design-linked incentive and PLI schemes, which provide capital support and production-linked subsidies, making their high-tech expansion financially viable. Kaynes is also not dependent on a single industry. Its revenue is well distributed across sectors that are currently in a multi-year growth phase. For example, providing mission-critical electronics for the Indian Navy and ISRO, supplying power electronics for electric vehicles and smart grid infrastructure, and a key beneficiary of the Kavach train protection system rollout and the indigenous medical device manufacturing push. Kaynes maintains a balance sheet that supports aggressive expansion. As of January 2026, the order book remains robust at about 6,000 crores, providing revenue visibility for the next 2 years. With the OSAT plant coming online, EBITDA margins are expected to expand from the current 14 to 15% towards the 18 to 20% range by the late 2027. While they have taken debt for the semiconductor capex, their debt to equity of 0.45 remains healthy due to strong internal cash flows and successful qualified institutional placements. It is a long-term play though, so I would buy on large dips and forget about this stock for the next 10 years. Next, we have Lloyd's Engineering Works, which was formerly known as Lloyd's Steel Industries. It is evaluated as a strategic niche player in India's heavy engineering landscape. The company has successfully shed its legacy as a generic steel firm to become a high-value equipment manufacturer for the defense, nuclear power, and marine sectors. The core of Lloyd Engineering's valuation in 2026 is its high entry barrier business model. It is one of the few Indian companies holding the stringent certifications required to manufacture equipment for nuclear power plants and the Indian Navy. These certifications act as a natural moat, preventing new competitors from entering the space. Their shift away from commodity steel towards high precision fabrication for pressure vessels, heat exchangers, and deck machinery for naval vessels has structurally upgraded their EBITDA margins. The company's performance in early 2026 reflects its transition into a high margin business. EBITDA margins reported at significantly higher levels compared to its peers in general engineering are always a good sign. As of mid-January 2026, the order book is robust, fueled by multi-year naval modernization contracts and the Indian government's mission to triple nuclear power by 2030. The company has maintained a healthy dividend payout ratio, signaling the management's confidence in steady cash flows. Cane is and will always be both expensive and volatile. It's an investment stock and should be treated as such.